Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 91. As always, joined by the three amigos. We've got Keith Dicker, IceCap Asset Management, Rich Diaz, Acorn Macro Consulting. What's going on, gentlemen? Rich, you're back?
I'm back. I'm in Montreal for a little while. It's really hot. I forgot how horribly muggy it is. And I'm convinced that the Pierre Elliott Trudeau airport is basically a third world airport. It's a complete bordel and it's an embarrassment, but passport control was zippity-doo. So there you go. It's really quick. Go through passport control only so that people could wait for an hour and a half to get a car.
Did you fill your Arrive can?
No, I did not. It was great. No, genuinely. Normally I complain about passport control in Montreal, but it was actually great. So you got to give them their credit. Although to get my mother had to wait an hour and a half worth of traffic to pick me up. So, anyway, that's me. Boring old Rich. Sunny and yeah, Keith, what's going on in Halifax? Please.
Listen, I've done some travel. Yeah, I did some traveling, as well. And I find passport control, both Canadian, US side and even the European side has been really good. So I haven't had any challenges. But you mentioned the Montreal airport, being, what word did you use to describe it?
Third world.
Third world. I think the German joke on the world has to be the Frankfurt airport. Has anyone flown into Frankfurt before? Then you know what I'm talking about. Well, it's like a bus station. You land out in the middle of the.
Oh no, it's Munich. Sorry, I was in Munich.
Yeah, sorry. Frankfurt is a bit sloppy. But I'm not sure if there are any great.
The airports in Europe are brilliant. London Heathrow is amazing. It's one of the most important airports in the world, and you're in and out in no time at all. So,
yeah, not Frankfurt. It takes a while to get through that puppy. Does anyone have really, besides Rich, in love with every airport except Montreal? Let us know if you have a really good airport experience, because it's easy to beat on those guys, including the airlines, because you get one little trip up. And off she goes. But we're happy. We're having a good kickoff to July here. And you, Steve, what do you got there?
Yeah, no, just back from God's country in Lakeside in Penticton there. It was super nice for the Canada long weekend. I was busy, having a couple drinks, watching the NHL free agency. So that was a good time. Back into it, like a good Canadian.
Yeah.
This the king of Kitsilano, hey? What a lifestyle.
Like now you got the snow globe. You're back, eh? The snow globe is back.
I have R2D2 here again. Okay, what do we got this week, guys?
What do we got this week? Just a quick before we get into it is we've got our event in Vancouver, live event. So the tickets, we appreciate everyone's support. Over halfway sold. So we still got some more tickets left. If you want to go check them out, again, there'll be a link in the description below. Where you can go and grab a ticket. You're going to see some sort of weird price. It's like $54.37. And I promise you, we set it at $49.99, but there's all these weird Eventbrite fees and stuff in there. So the Loonie Hour is unfortunately only pocketing $49.99. That gets you into the event, complimentary drink, and a whole bunch of appetizers and whatnot. And of course, live podcast, Q&A should be a great time with a whole bunch of the other Loonie Hour people.
And you get a chance to kiss Rich. So I want to get a whole bunch of photos for that night of people planting one on Rich's cheek there.
I just want to know, does the event have air conditioning?
I'm told it will have air conditioning.
Okay, because I'm dying here. My mom's air conditioning sucks. She can probably hear me say that.
You're gonna get the boot. As always, open it up on the housing front. So we're now into July. We've got some of the June housing data coming out, and this is kind of what people are now. If you gauge the sentiment online and Twitter, everyone's sort of gauging, okay, spring market, which is always historically your busier time of the year. We're now going into the summer months, where it slows down. You tack on these rising mortgage rates over the past 4 or 5 weeks, and everyone's kind of like anticipating the slowdown. So we're starting to see some of that in the Vancouver Toronto data. So Toronto home sales on a seasonally adjusted basis, declining. So that kind of strips out that volatility there. Interesting enough, it's like sales are actually up in the GTA 17% from last June. So it kind of goes to show you that like how bad, like basically the market froze last summer when Tiff Macklem was raising rates, 100 basis points at a time. So we've kind of like unfrozen, but I think we're again starting to slow down. New listings are trending higher. Inventory is still incredibly low, but picking up. And it's a similar story in Vancouver. So sales up year over year, but you've got new listings basically right back now, finally in line with their long-term 10-year average for the month. So keep in mind that in Greater Vancouver, for the first four of the past 6 months, you've had 20-year lows in new listings, which is insane. For the past 6 months, you've had 20-year lows in listings. We've now, for the month of June, had a normalization back in line with the 10-year average. Again, inventory is still low, but if that trend continues, which is, hey, sales kind of slow down moderately, listings start normalizing, picking back up slowly over time, that allows inventory to build. And as inventory builds, it puts pressure on sellers to reduce their prices. So still way too soon to make any calls. That's kind of what's happening in those two major markets. And then, of course, Calgary, which is that one market that continues to sort of buck the trend. Record home sales for the month of June. Home prices up for the past 6 consecutive months. So that's a market that continues to like not really be impacted by interest rates, at least not yet. People forget, everybody in Vancouver and Toronto, I think, has like this 10-year history of like, oh, Vancouver and Toronto, it's so expensive. And there was a time in the early O's when Calgary real estate prices were more or less almost on par with Vancouver, Toronto. It was slightly cheaper.
Wait. Sorry, for price per square foot type thing?
Just in general, like resale prices. So like the Vancouver and Toronto was always more expensive, but like the gap, it just blew out over the last 10 years specifically. Because like Calgary real estate basically actually peaked in like 2007, went sideways for a number of years, and then peaked again in 2015, and basically has been a very flat market. So it'll be interesting to sort of see how that market sort of shakes out.
I have a question for you, Steve. In line with one of the themes we've talked about now for a while, what is happening in Calgary with population growth?
Yeah, we had some data out last week. It was, I think it was the largest. So in Alberta's on track. Alberta, not Calgary, but Alberta population growth is on track for the fastest population growth since 1914. So they're growing at about 4.6% right now.
Actually, looking at the data in front of me, so in order of like fastest growth is PEI with almost 5%, but there's only like 200,000 people who live there. And then it's Alberta with 4.6. There's about 4.7 million people. Then Nova Scotia, they just cracked 1 million with 4 and a bit. And then New Brunswick.
Your house is going up, buddy.
That's right. And then New Brunswick, which is about 800,000, and they're growing around 3.5. And then Ontario is next. They have 15.5 million people in Ontario roughly, and that's growing at 3.5% too, which is absolutely, by the way, totally freaking nuts. And then BC. So those are the 6 provinces in that order with the highest population growth. Steve?
Yeah, and I think
to be fair to PEI, I think the population is 125,000. What is the number?
Not according to Stats Canada in my research, but
what are they showing?
I could be wrong.
What are they showing there for PEI population?
It's closer to 200,000.
Okay, 200. So not 5,000.
Yeah. No, I said no. You misunderstood. You are hearing impaired.
It is true.
Anyway.
I'll
tell you the exact number. Anyways.
Well, yeah, I think there's a case to be made that, like, again, no, I don't know. I'm not going to pretend that I know where the real estate prices are going in the next 5 to 10 years, but I think there's been so much growth in Vancouver and Toronto. Like the numbers are just obviously not they have made sense for a while, but more so in a higher interest rate environment where I still think there's a strong argument to be made that you'll see Alberta real estate will arguably outperform. I think like BC and Ontario, I think could underperform. You could see flat to no price growth for the next 5-10 years, and you see maybe modest price growth in that province, despite what's happening in interest rates. So I think that's kind of also in some important context that, like, I know we always talk about like national markets, but like housing is very much like a region specific. So, I think that, that's kind of what we're seeing.
Can I ask you? Sorry. Can I ask you a question, Steve? So I retweeted this thing, which I don't know if I wanted to get your view on this. I've been waiting all week, where this gentleman retweeted sort of all of the paperwork necessary in order to fix up their bathroom. And I think that they went through so basically, so people who didn't know, that he like listed the sort of 6 or 7 different either paperworks or permissions or permitting that you needed in order to just basically redo a bathroom. Can you, first of all, A, is that true? And B, how does it compare to places like Alberta, etc.?
No, I mean, that's 100%. I mean, I actually know the guy that, tweeted that out. Him and I have had quite a few conversations over the years, but yeah, I mean, it just kind of comes to the whole point that like the public sector in I think in most part of Canada is just, it's so large and bureaucratic. And it definitely, in Vancouver, I think I've told this, I work day to day in the residential space. I tell most of my clients, like, you do not want to build a new custom home in the city of Vancouver. Don't. Like 99.9% of people should not build. Like, even if you have the money, don't build. Like, you're going to just drive yourself insanely crazy. It's so expensive to build. There's so many layers of government. It's basically like, to build here, start to finish, it's going to be like a minimum 2 to 2.5 year process. Because the first like almost year is just going to be like architectural, dealing with the city, getting the permits, and then you're going to be at least another year to build it.
And compare that to Calgary.
Calgary permitting time will be approximately half the time as Vancouver. So,
and Steve, is there any acknowledgement or recognition that that's not an optimal environment to promote growth of any kind? Or is it the perspective that just the way society has moved over the last decade was that government knows best, government needs to be involved, and we will tell you how we're going to be involved? Like, did you see what I mean?
Yeah.
What's
well, I mean,
happening?
to get like a parcel of land, like rezoned for like an apartment building. So let's say you got a parcel and you want to rezone it and build, 5-story apartment building or something. Like, you're going to be 2 to 3 years just on the rezoning process. And then you're going to be another, at least another year on the building permit, development permit process as well, year and a half. So that's why I say, like, it takes like to start from finish, it's going to take you 5 or 6 years to build like a wood frame condo in the city here. So it's just, and that's where
condos are still being built with wood frames. Where are you guys?
You go high rise, and that could be like an 8 to 10 year project.
Okay, so very quickly with this, then, what is one step that can be removed or added? You don't want to add anything, but what? You're in that space, and myself and Rich, we're not. What can happen to cut that time by 25%, from 2.5 down to, say, a year and a half, a year and 3/4?
I think they should have like an automated. So I think my understanding is back in the 70s, 80s, they had this product called the Vancouver. It was called the Vancouver Special. And so basically it was just like this templated house where like they all kind of looked the same, but like if you had the drawings and like basically they rubber stamped it. It was like, yeah, you can build this, like this sort of plan, this house is already pre-approved. And so, I mean, I suppose that's one way, and they're actually quite a popular house today, even, 30, 40 years later. People love buying them and redoing them because the floor plans are really good. But the problem basically with the city is like, and now it's funny because everybody now works from home. So it's actually gotten even worse, because like what happened when you had a permit request or you wanted to speak to somebody, you could go and stand in line at City Hall for 3 hours, and eventually you get to the clerk at the front desk and you can talk to them and hash it out and get an answer right there with someone in your face. And now what happens is it goes and you send out an email, and then the email, they'll respond to you in 7 days, and then they'll forward your email to like somebody else's department. Then you got to wait another 7 days. And so this is basically what happens is everyone just kind of passes the buck, and it just kind of goes in this long daisy chain. And eventually someone will sort of get there. It's honestly horrible. And that's
awesome. That
getting-
that just sounds like the Simpsons or something, right? It's
well, so I'll
Yeah.
get to this like whole like long story here, and we'll switch conversations.
Wait,
here, but-
before we switch, I want to give the guy his due because he wrote his name. Sorry, Steve. His name's Avi Barzalia, and it's at East Van Builder. And I would recommend you go check out his tweet. It's absolutely ridiculous. And to his credit, he puts all of the paper. He does a really great job. So sorry, carry on, Steve. I just wanted to give the guy.
Well, Rich,
I mean,
Rich,
basically what it's,
wait, Rich, you should steal his tweet and send it out.
I would
We're
never
not
do
going to let that go. Some guy did an unjust to Rich last week, so we won't let
know
that
who
go.
you are.
Looney Hour
Let's-
people, get them.
Let's move. Let's move along,
Anyways, but
please.
suffice to say, this is why, like, when people do like renovations on their house, if it's a single family house in particular, a lot of people aren't getting permits now because they're just like, this is insane. I'm going to redo my kitchen and redo a bathroom, and like, there's no way for you to know unless you're physically coming into my house. So it's somewhat of an honor system. And so at this point, your system is so insane, I'm just going to do it without a permit. Anyways, switching gears, kind of on a similar topic, is the FCAC. So a lot of people weren't necessarily familiar with them. It's the Financial Consumer Agency of Canada, but they sent out an issue to all of the national Canadian banks, I believe it was yesterday, saying that they want the banks to strengthen policies to assist mortgage borrowers. So essentially, they issued a memo saying they want the banks to work on amortization extensions, waive lump sum prepayment fees, and they want banks to waive prepayment fees on distressed sales, and then again waive interest on capitalized interest. So basically, they don't want banks charging interest on top of interest for customers' mortgage balances that are negatively amortizing. So essentially, they want the banks to proactively work with borrowers, and this is what we come to, like this great big Canadian housing trade, which is artificially supported by almost all levels of government. You'll remember in the federal budget at the start of the year, Chrystia Freeland specifically noted in the budget that they want Canadian banks to proactively work with people that have hit their trigger rates and are feeling the stresses of their mortgage payments. So I'm not saying this is going to eliminate risks and foreclosures in the housing market, because they're absolutely coming. But it's pretty evident in policymakers that they're going to support this asset class to the best of their ability.
So
You
nothing's
talk about
changes.
affordable housing. Houses obviously get more affordable when you have price declines, but price declines also politically aren't that popular in terms of getting you reelected.
So how would it work again? Let's just run through this. Say Rich Rich wants to leave. He doesn't want to live with his mom anymore. He wants a place with air conditioning, but he needs help. So how is this going to work for Rich?
Well, he needs help in terms of, like, it's more for people that already have a mortgage, right? So it's like, okay, if Rich, bought a house during the depths of the pandemic, he took on a variable rate mortgage at 1.2%. He's now hit his trigger rate because the variable's, 6% or whatever. So he's effectively not even paying. Not only is he not paying any principal, but he's actually not even paying all of his interest payments. The banks are just tacking that on to his balance. So Rich's mortgage balance is not shrinking every month. It's actually growing. And so it's going to create this huge problem in 2.5 years when Rich goes to renew his mortgage. The banks are going to say, hey, buddy, you got to fit this new payment under your remaining amortization. So you're going to have this massive balloon payment, basically. So the banks essentially are saying, okay, legally we're only allowed to issue on a new origination a 30-year am, but your amortization is now blown out to 70, 80 years. And you're telling me you got to fit that 80-year amortization on renewal back down to 25?
I have a comment and then a question for Keith. My comment is, it wasn't my fault. I was told by the central banker, the most important central banker in Canada, that they were going to keep rates low for a very, very long time. And then my question for Keith is, Keith, how does this affect earnings for banks?
Well, I would imagine though, if the banks are being forced to do this, they're actually being compensated for it somewhere in the back channels through Ottawa. So at the end of the day, they socialize this cost. So I'd be surprised if the banks are actually taking it. But if the banks are taking it, then, remember, banks are pretty smart. So they'll just simply tap it onto some other poor schmuck in another product, expensive investment management solutions or something like that.
I think you're seeing that though today on new mortgage originations. Like we talked about in this last week's episode, but what I'm seeing is the banks are aggressively raising mortgage rates so obviously bond yields have moved significantly over the last 6 weeks, but the banks have been extremely quick.
Actually, significantly over the last 4 hours. The bond market is getting mullered. This is Thursday, everyone. We record on Thursdays, and equities are getting. Everyone looks at the stock market first. It is what it is. But the bond market is just being scorched earth here.
Yeah.
Today,
so we just back 4%. Sorry,
your Canada.
Yeah, and then tomorrow then tomorrow we get the non-farm payroll number from the Americans, and if that's a strongish kind of number, we could be looking at a pretty aggressive down day going into the weekend. See, what'd you say the 5 years at now?
Yeah, it's at 3.94. So the previous high, I guess, for this cycle was last October. It hit 3.84. 3.84. And of course, obviously, housing was extremely soft at that point in time. So now we're at 3.94. So, we can see mortgage rates based on today's move could move up again starting next week. So yeah, again, suffice to say, I think almost if this continues and holds, I think you could see almost all of your new mortgage originations having a 6 in front of it. And so I think it's natural to conclude that should that hold, I think, yeah, you're going to see pressure on the housing market. Again, we're going to need inventory to build. But at some point, enough people renewing with a mortgage and with a 6 in front of it, it's going to be it's going to be troublesome for a highly levered household, highly levered economy, I think, for that matter.
All I wanted to add was that misery loves company. And we talked about other interest rate sensitive countries. So what does that mean? It means countries that borrow at the short end of the curve. Sorry to repeat myself, but and the same thing is happening in Australia, down 5% year on year. These are my lagging kind of crappy house price indexes, but they're pretty okay. New Zealand down 10%, South Korea down 7%, UK down 4%. Germany down another 5 or 6, depending on which index you use. And all of these countries basically have the same issue, which is that homeowners and mortgage borrowers borrow mostly at the front end of the curve. Meanwhile, the US house prices index continues to rise. So interesting what's going on.
Yeah, I think on the Canada front, right, is like that's like I can tell like the HPI on a national level is still showing like a year-over-year decline. I think a lagging indicator because everyone had the huge spring market uptick, and then So, but again, I still think like moving forward, like again, a lot of this talk I think was okay. Mortgage rates were like last fall in Canada, they were about 5.5%. Housing activity slowed. Into the new year, we got rates down. You got, you got mortgages with a 4.7, 4.8. Bank of Canada went on pause. So we had the housing market lifted and prices basically re-lifted almost back to their peaks of 2022. And of course, now all of a sudden everyone's going, okay, well, hold on. The Bank of Canada is now off pause. Yields are surging higher once again. Now eclipsing last fall. And so, yeah, again, like I think the story and the narrative is starting to shift in the market once again. So it's going to be interesting to see how the next 3, 4, 5 months play out.
It's kind of interesting because it ties in with, you remember last week we talked about the 4 central bankers, the Europeans, the Brits, the Yanks, as the Brits would call the Americans, right, Rich?
Yep.
Yeah, the Yanks, and then the Japanese. Do you remember we talked about how they're all hawkish and they're focused on the labor market and stuff like that, but yet equity markets and credit markets specifically are telling everyone, we don't believe it, and they're going to stop hiking rates imminently. We don't believe them. And I think so. I think that now it sort of ties into some of the data points we had out today. Maybe yesterday, maybe Rich can go through them. But the overall summary here was that the data points out today is especially they're really strong. So the American numbers are suggesting the economy is still solid, and which implies the Fed will continue to hike rates, which implies that equity and credit markets are wrong, that they will stop hiking rates, if you can follow sort of the bouncing ball here. So that's why we have this incredible risk off day right now. But Risk, why don't you share with everyone how strong some of these numbers were down in the US?
Yeah, sure. So I mean, one of my favorite words is a diffusion index. And as people who listen regularly will know, there's the most important one by far is the ISM, Institute for Supply Management. It's out of Arizona, I believe. Anyways, so last week they did the manufacturing, which wasn't so hot, but I think it's important to remember that in the US, it's the services industry is about 75% of the economy, about 65% or so of personal consumption expenditure. Canada's a bit less, but this number beat expectations. Remember, it's always about sort of the number versus what the market's expecting. And then it's also about whether the number is above or below 50, so expansion or contraction. And so the ISM non-manufacturing, in brackets services, rose to 53.9, and that's important. So it's the direction, which is growing. It's the rate of change, which is faster than it was. But also, it's important to look under the hood. So again, forgive me for repeating myself, but there's new orders, there's employment, there's suppliers, there's backlogs of orders, there's imports and sentiment. And, a couple of very important components were all growing. They moved from contracting to then growing. So we have better orders in the US, faster delivery times, better activity in production. So that's one. And then, I won't go on and on, but it's basically a really solid number. And then another thing that just keeps on doing, again, okay, is the JOLTS came out. So the JOLTS fell down. So the job opening labor, you always forget this damn acronym, for Christ's sake.
Job
Anyways.
openings and no, now you confuse me.
Anyways, it's a job opening. So now there's 9.8 million jobs, but relative to the number of people unemployed, it's still a really, really strong number. So we still have some of those issues. Car sales is another one that actually came out. So there's car sales. You can have light trucks, passenger sales, and then there's heavy trucks, and those are usually a decent coincident indicator for how well the economy is doing. And that number didn't beat, but it continued to accelerate. So tomorrow, Keith, you're going to let us know about how the Fed's going to interpret this. But tomorrow's the non-farm payrolls, right? It's the first Friday of every month. And it's probably the second most, or maybe the most important U.S. economic data. And Keith's going to tell us what's going on with the Fed and how they're interpreting it, because there was some minutes out, right, Keith?
Yeah, two separate things. So we had the Fed minutes came out yesterday. And we talked about this before as well. So, these are literally the minutes that the Federal Reserve crafted, or basically what was said and agreed to during the last Fed meeting. So it's probably 4 weeks old. Yeah. And from a market perspective, you want to figure out, okay, do the minutes reconcile with what was said in the official press release and also during the Q&A? And to remind everyone, at the last Fed meeting, that the Fed did what do they call it? Not a pause, a skip, right?
It was a hawkish skip.
A hawkish skip, yeah. So they didn't hike rates, but they paused and they strongly suggested they are going to hike again for the next maybe 2 meetings. And what happened when the minutes came out? Not only was there a unanimous agreement to pause, but over half of the participants said they would have agreed to a hike as well as a pause. So again, it was a very hawkish moment in central bank world. And then so we have that combined, with the ISM data that Rich just shared with us. So again, it's going down this path where central banks now they want to continue hiking rates, because remember, so we'll quiz Steve on this. What was the number one criterion that the central banks were talking about in Europe a couple of weeks ago?
Climate change.
I put you on the spot. I'm sorry, Steve.
Oh, we're gonna be banned. No, it's the labor market.
Yeah, absolutely. Yeah, it was the
labor market.
workforce. Yeah, we have the labor market. So, and the only way to put a dent in that is to have job losses coming up. So, which leads into tomorrow's data point, which is, we call it the non-farm payrolls, because that's what they coined it way back in, back when I was a kid, back in the 30s and 50s and whatever. But, the premise then that was more a better consistent number of employment growth compared to the farming industry. Yeah. Which
and military. They usually, sorry to interrupt you, but they usually exclude the military from that as well.
Yeah, sure thing. So to give everyone, last month's number was 339,000 new jobs. The estimate for tomorrow is 225,000. So, growing slower than the previous month. So we'll see what the number comes out.
Is this a Twinkie bet?
Yeah, so then we pay up next week, right? So we'll do that. Okay, so the estimate is 225. 225,000.
Ooh, Keith, go first.
Okay, I think the number will come in at 330. What do you have, Rich?
Damn, you always go first. You always screwed up. I'm going first next time. Mine's 315, I guess. Damn it. That's auction for. Oh, here's a good pickup line. Do you know what auction theory is? Because that's basically one of the things you learn.
I'm gonna go 225, 100.
What? What is that?
That's Steve's commission on the number for the month.
Yeah,
I'm actually gonna go. I'll go under just to keep it spicy. 224.
I like it.
It's like the Price is Right, $1, $1. Yeah.
224.
Is that the auction theory? That's what it is?
No, but there's different types of auctions. There's a Dutch auction, there's a normal auction, there's American auction, and it's important that if you go first, it affects all the numbers that come after it. So anyways, sorry, I just nerded out there for a second. That's auction theory.
Hey, Rich, I've got a question for you, actually, when you kind of put all this together, because again, I feel like there's so many, I know everyone, listens to the show here. Everybody's got an opinion on, and exactly what's going to happen 6-12 months from now. I do not. I think that I have an opinion.
I do. I have a strong opinion.
I mean, I've got an opinion. I still think personally, again, I try to look at all different aspects of, there's so many people on Twitter. I think some really great research that's put out for free, and some of my stuff I get that's paid. And so I get a lot of pretty good intel, I think, that comes across the desk. And you're kind of like, okay, you try to look at all the different angles, including Acorn Macro Research, free plug. But it seems to me like I feel that CPI is coming off. Now, we had Canada's CPI last week, which we didn't touch on last week. We forgot, actually. Headline inflation came in at 3.4%. If you stripped out mortgage interest costs, which I know people say, well, you can't do that. We had headline CPI at 2.5%. And then I see, okay, ISM, prices paid, still coming off, et cetera, et cetera. So there's an argument to be made now that people are saying, and it could be right, could be wrong, is that the base effects comps are becoming more difficult in the months ahead. Mm-hmm. So I'm kind of curious, what's your personal view on, let's say, headline inflation over the next 3 to 4 months? Because you've been right. I mean, you said 6 months ago that you said, hey, listen, our models are showing, Canada's inflation getting down to 3% by the summer, and we're at 3.4 today.
I think that there's, so that's a huge thing. I mean, the inflation, I thought you were going to ask me about whether or not the US was going to slow down. That's what I thought you were gearing up for.
Well, I mean, I think there's a lot of data it's almost like, I think macro just moves really slowly, and there's all
it's lagging for sure. We're always looking in the rearview mirror, to be fair.
There's all this conflicting data. It's like, well, one data set says this, another data set says that, and everyone's basically arguing online about who's right and who's wrong.
So on the inflation thing, I just think inflation, my view hasn't changed on that. I think inflation will come down. Headline will definitely come down. It'll be dragged by the base effects that you discussed. Those base effects include energy commodities, which is the fancy words of saying oil price, energy services, different goods and stuff, as people sort of have shifted and sort of the supply chains issues get dealt with. And so the headline number, I think, will continue to go down. I also think the core number will continue to go down, but I think it's about it's about this whole stupid transitory word. Do you think we will return to the high 1.8 handle or back to twos, or do we think we're going to be structurally higher? And for me, that ultimately, when you're thinking about inflation, it's not about whether a headline will fall back to 2% or whatever. I think that will do. In my view, Steve, I think it's about whether or not core will stay structurally higher. And people know that why I've said so. I'll do it really quickly, which is government deficits and tight labor markets. The issue with the IRA, Inflation Reduction Act, and the supply chain decoupling. And so I think, Steve, does that make sense? Does that sort of answer your question on the inflation bit?
I mean, I think you and I share a similar view then, which is that, you probably arguably are in a structurally higher inflation environment in general.
But Canada's different, though. I think that's really important, right? So Canada does not have the same wage pressures that they do in the US, right? Canada's wage growth is, let's say, 2 and a bit. US wage growth is 6 and a bit because of, people don't want to hear it, but because of population stuff, because of crappy productivity growth, on and on. And so I think we got to sort of separate those two animals. The US is arguably doing much better, I would argue, as an economy than Canada is. And we know per capita GDP is declining in Canada. Per capita GDP is rising in America. I think it's important we don't sort of conflate those two things. The other thing is that I don't think consumers in Canada have the same safety net. Debt to GDP ratios in Canada are 1.115 or whatever. In the US, they're 70. And debt service costs in Canada are at all-time highs. Household debt service ratios that are all-time highs. In the US, they're at 20-year lows. So you stack a couple of these things together, and you're in a situation where I think one economy will do structurally much better than the other.
What do you think, Rich, is the biggest risk for Canadians then, from a financial economic perspective, considering all the metrics that you just shared with us?
I think that the biggest risk is that there's a global slowdown, and things that keep our currency and keep the game going disappear. So our terms of trade is directly related to oil price. If there really genuinely is a prolonged slowdown in the global economy, the oil price will collapse, and Canada's basically the thing that keeps Canada's terms of trade even in remote respectability, which is oil, will collapse. I think if there's a severe slowdown in economic growth globally, I think immigration will slow down. And we've complained about immigration a lot, but the fact is, if people come to your country will grow. And if that slows down, I mean, if you think retail sales are bad now, imagine if 1 million people didn't show up tomorrow. And then there's the pro-cyclical issue of those credit issues. So I think Canada's very, very sensitive to the external world, something, Keith, you've mentioned many, many, many times. And Canada's shit productivity growth, which is just something I've gone on and on about. Does that sort of answer your question, Keith?
Yeah, but I agree with that as well. I mean, I think I've been sharing my view now for a while, and I like to say I haven't been right yet. No, I don't mean it. That didn't come across the right way. It's going to happen. It just hasn't happened yet. And what I mean by that is it's inevitable that we're going to experience a slowdown here coming up. And, and I said this before, that the challenge for Canadians and Canadian policymakers, if any of you guys are listening here right now, if we do get that slowdown or a hard landing, no one's even thinking about that. I mean, the Bank of Canada is saying, no recession. I know Ottawa has forecasted never to have a recession ever again in the next decade and all that. But if we do have that coming up, and the economy has become so reliant upon a strong banking, which is a credit lending sector, if we get a recession that comes out of Bay Street instead of a regional recession from, say, Alberta and the energy producing provinces, we won't know what hit us because we haven't experienced that before. And, it's going to create a lot of, dislocation. So we have to look around the world and say, hey, what's happening? What is the potential here for this to trip up? Which sort of leads us, talking of trips, I think we discussed earlier, it's on the news that, so the head of the U.S. the Finman for the U.S., so Janet Yellen, she's heading to China today or tonight for meetings, which I don't think it's a coincidence that she's arriving there just at the exact same time that the Chinese are experiencing an incredible amount of stress on their banking system and a US dollar need for cash and so forth. Remember, everything is connected here. So I do think that we are getting, increasingly closer to something happening. And Steve, I think you mentioned this there a few minutes ago. Maybe the risk for Canada that sort of trips us up, it is an external event, and that's what it's increasingly looking like.
Yeah, I just think like everybody seems to have this sort of linear approach to the economy, right? Everyone's like, oh, whatever, the ADP jobs or ISM survey, like everyone's just extrapolating that, you're going into this soft landing, so interest rates are going to stay higher for long. Like everyone just, nobody ever really sort of, I guess, sees there's always some sort of financial event typically, right, Keith? I mean, as you go into these very, very aggressive rate hiking cycles, I mean,
so even within Canada, so the financial event we have coming up now is that there's going to be a ton of mortgages that will be up for renewal, like from that 2000 trough, that is coming up. Everyone on, say, a 3-year cycle. I was chatting with a gentleman yesterday, in the not quite GTA area, but a little bit south of that, maybe you'd call it. We're just, and he and his family, they're very conservative fiscally. Like they spend when they have it, and if they don't have it, they watch it. But he's just commenting that like his mortgage payments have increased, I'm going to say about $800 a month over this cycle. Now his actual payment hasn't changed, but he's been putting aside that what it would have increased by if his variable mortgage wasn't structured that way. But just commenting in general, he said, they used to go into the city, a hotel was $250 a night. Now the same hotel is $500 plus. They go out and grab a burger and sandwich and maybe a drink each. That used to be a $50, $40, evening. Now it's $120. And you keep coming down to it. If rates continue to go higher, which is what the Bank of Canada is telling us what they're going to do, and then you get job losses on top of that, it just becomes less money available in the aggregate economy, and it has to show up somewhere, right? It's going to come here. And, I think the real risk area for financial markets, it's going to be the corporate debt markets and even banks. I mean, I'm looking at I think it was Scotiabank stock this morning, and this is not a suggestion either to buy or sell it, but it's now getting closer and closer, to going back to the lows of the 2000, sort of the 2020 market event. So watch bank stocks. They are signaling to us that things are getting weaker. And we should be on the earnings cycle for banks coming up shortly, which we get to look at. What's our favorite metric for the banks?
Loan loss provisions.
Yeah, we get to look at that one.
Keith,
yeah,
but I think you've kind of just like summarized. It's just like, I think sometimes we just end up overcomplicating it, which is like, oh, this survey, this household survey, this metric. And it's like, okay, like I think you can just extrapolate and say, listen, if everyone's mortgage payments are going up by $1,000 a month, $500 a month, $1,200 a month, extrapolate that across, all these households, give it time. It's going to be, I always like laugh because like the BMO guys were out, the one of their economists, I don't know, two weeks ago, but like, hey, listen, like housing data is still like house prices have been going up. This is like Bank of Canada needs to keep raising rates. So it's like, again, like you actually like dig through it. And it's like, well, they've been going up because you've had 20-year lows in new listings. It's like, it's not really a market that's booming. Like it's interesting because I just think that kind of missing the forest for the trees.
Well, that's I think it's a really important point. And I when you say you don't want to overcomplicate, I love overcomplicating things. And one of the ways I do that is by always thinking about sort of how
Is that why your dates are a bit of a lower number?
Definitely. That is definitely one of that is definitely one of the reasons. But one of the things I try to do, which is hard, obviously, is a thought experiment. How could it be wrong? So I've been quite negative on global growth. I've been probably too early to it. as many strategists are prone to do. And one of the things that I often forget is just how strong the U.S. consumer is, and the U.S. consumer is more, is a 75% or whatever the U.S. GDP. It's the most important consumer in the world, and that the fact that they have a couple of things lining up for them is a way that maybe all of this the world might just be able to ride this sort of I don't know, animal, donkey. What do they ride in America? Pickup truck, the American pickup truck, just for a little bit longer. The lack of debt.
Donkey. People are riding donkeys in America.
No, I'm just saying, like, if the U.S. house consumer is as strong as I presume it is to be, which is household debt servicing, wage growth, unemployment, lots of labor shortages, house price growth going up, wage effects from the stock market. You have a situation where if it just muddles along, it'll be very difficult for the global economy to materially slow. And if that's true, you have a situation where the Federal Reserve will continue to feel the need to raise rates. And ultimately, the reason I think people like me are just very worried about global growth is because, the yield curve, there's a great expression, cycles don't die of old age. They're murdered by the Fed. And the reason Ben Bernanke said that is because he knows, he's watched cycles for, despite his many misgivings about quantitative easing, the guy's a smart guy and understands cycles. And his point is what Keith alluded to earlier, which is the Fed is focused on the labor market. And until they see weakness in the labor market, they're going to continue to raise rates. If you raise rates long enough, you eventually get credit events. If you get credit events, you get capitulations.
Right, but labor and very good point. But labor data is also the most lagging of indicators.
Ding, ding, ding. That's the game that we're all sort of playing. And so that's the trick, right? So people argue, for example, there's a guy on Twitter who's, he's been bitching about how the ECB is super, super hawkish and continues to be. And yet the data out of Europe is horrible. The IFO is down, Centex Intimate down. There's a thing called the Citigroup Economic Surprise Index, which is the lowest it's been in like 10 years. And yet the ECB comes out and says, well, we want to be hawkish because the labor markets are okay. So Steve, you're 100% right.
And again, I think that comes down to like the political aspect of central banks right now, which is like,
right.
They messed up so badly, particularly over the last couple of years, that there's all this political pressure on, like, you can't be seen cutting rates with jobs numbers that are still coming in above expectations. You cannot be seen as the person so you have to almost wait for that data to deteriorate. So you have the air cover to politically start cutting rates.
I think very well said. I don't know, Keith, if you agree, but I think that's really well said.
I agree with it. I mean, I'll say something that may not be well received by some people, but sometimes you can have overemployment. Now, I think that's clearly the case. And let's use the barista example. And what do you mean? A barista, in my opinion, it's a skill job. To make that nice coffee that you want in the morning, you have to be able to know what you're doing and stuff like that. As well, some of these coffee shops are incredibly busy. So not only do you have to make a quality drink for someone, but you got to juggle them. Like you're just working so fast, get things out. And then you want a lemon loaf, of course. And but not just at Starbucks though, but like at any of these other places. And I was just traveling. It was just shocking how low the skill level was at some of these baristas. And people might say, like, rolling their eyes, oh, come on here. But the point is that a lot of jobs now, that people are just starving to get someone in there. And so you end up, so this is the way the cycle works, and it's the way it should work as well. It's the capital markets, in an efficient economy, that, eventually you're paying a lot of money on wages and salary and benefits for someone that's not doing not producing a great output. And eventually your product or service will suffer, then you lose business, and it happens on an aggregate level, and it just rolls over. So I think, so that's clearly the level we're at today. So with overemployment, so when the Fed says, yeah, we're watching labor markets, when the ECB says we're watching labor markets, and on, like they really do want job losses. And I think Steve or Rich, when you guys mentioned earlier, the ISM data earlier for the goods sector was weakish,
Very weak, yeah.
46.3
or whatever, yeah.
Yeah, not a diffusion index. That's not good. It's not growing. Services is still positive, and all those numbers is. So that's kind of the barometer that you look and feel for. So it's there. Do you guys want to move along to the bill C-18? Because we had Professor Geist on there a few days back. I think we're getting a continuation of his views over the last 24, 48 hours as well.
Yeah, if you haven't heard the episode with Professor Geist, we had him on. He's sort of an expert on Rich? What do you say? Internet law, internet sort of censorship. Like it's that's his whole shtick. That's what he does.
Yeah, he's a professor at University of Ottawa, and he graciously gave us some time sort of explaining two sort of bills that are getting either passed or already passing or whatever, and their effects on Canadians. And in my view, he was quite nuanced. I was hoping he'd be a bit more meaner, but he wasn't. He was nuanced, and yeah, Steve, he talked about Bill C-18 and sort of the concerns with that as well, I believe.
Well, yeah, and then of course,
that's it. That's all you're going to lead with.
Jeez, what do you mean? You really...
I thought you were going to go.
Yeah, you tee this one up, buddy. This is your shtick.
Okay. Yeah. Well, I'm very interested though I carry a sharp stick with it as well. I have a strong view on it, but it's not just in Canada, but the amount of political government interference in free speech across different platforms, whether it's traditional media or social media. Whether you can see it or not, I think it's quite obvious, but it has been throttled over the last number of years. And a lot of that is now starting to come to light, specifically when Musk bought Twitter and he started opening that up. And again, you can agree or disagree. If you disagree, you're just wrong. But with the bill C-18, I mean, one of the main premises with it is that if you're Google or you're Facebook or Meta, I think they changed their name to, which covers Instagram as well. If they want to feature in their news stream a Canadian content provider, then they have to compensate that provider. So pay CBC, pay Bell Media, and stuff like that. So they simply said, well, we just won't list it. We won't allow Canadians access to any Canadian generated news. And so that's what they've done. And it set off, people are running through Ottawa now with their hair on fire trying to get this fixed. And it's exactly what, Professor Geist he's been writing and tweeting about quite a bit. But something that maybe people don't realize is that I saw here earlier, 45% of Canadians get their Canadian news content from Facebook, Instagram, and Google. So basically half of Canadians are now, in theory, are being shut off from getting their Canadian news content, but they can still go directly to get it, of course. But I mean, who does that anymore? I know Rich doesn't have a Globe and Mail subscription, right?
No, I do not.
You do
Take
not.
that back. We want the Globe back.
That's a legacy joke, of course, for Loonie Hour people, if you know it. But what else is happening here? I also read Post Media and another company, Northstar, they're having merger talks. Bell Media, they're talking about downsizing their local distribution. So the amount, I can see the Canadian government's perspective in that Canadian generated news content, it is declining in quantity and the availability to get it. So I understand what they're trying to do. However, the market forces are stepping in saying, hey, that ain't going to work. And maybe it's a great opportunity for the Loonie Hour to put on a nightly newscast.
Oh, I don't think we need that.
Maybe.
I understood one of the reasons that these large companies are particularly vexed about this is purely just from an unfunded unknown liability perspective, if I'm not mistaken, right? In theory, if they have to pay for every click through and a story goes particularly outside some normal viral, goes Six Sigma, there's, massively outside the normal range of shares, the amount of money that they would have to pay would soar astronomically, and they would have no way of A, modeling it, B, hedging that exposure, and and C, it's nonsense. That's like, how could you force a company to take a completely uncoverable or unmodelable liability? And sorry, that was one of the things that really resonated with me, Steve.
What's Professor Geiss's tweet there? You want to tee him up?
I gotta find it. Yeah, so I mean, he's been on this, right? So by relying on mandated payments for links, Bill C-18 is deeply flawed, and stopping ads won't change much. Rather than pursuing ways to get Google to contribute, which is by paying higher taxes or funding issuers directly, the government's been talking about a tax on democracy, which of course is stupid hyperbole that adds nothing to nobody. The reality is loads of the experts have been talking about this for a long time, Mr. Geist aside. And exactly what they said would happen, and the government in their infinite wisdom ignored them. Keith, I don't know if you want to add.
Well, just to jump back on that. So yeah, in response, for those not following along at home, the Canadian government is now suspending its advertisements on Facebook and Instagram in response to Meta's plan to permanently end news availability on its platform. And I think the Canadian government, so the largest share of government spending on social media is via Facebook and Instagram. So the Canadian government spent $11.4 million on Facebook and Instagram, accounting for more than half of its total social media expenditure, and it spent $8.8 million on Google during that time, during the fiscal 2021-2022 period. So they're basically saying, okay, we're gonna stop advertising through your platform. So anyways, I guess the Canadian government's trying to get in a tit for tat with two of the largest tech conglomerates.
But it's also from a fiscal perspective, because that should help improve our deficit somewhat.
No. I mean, the reality is it's funny because Canadians have this really weird, we absorb sort of the political zeitgeist in America, when it suits us. Because I remember a couple of years ago, there was all this talk of net neutrality in America. And the CBC wrote article after article defending net neutrality, saying, it was screaming bloody murder that Donald Trump, who I'm not a fan of, his FCC chair, who he appointed, was sort of going to end net neutrality. I'm not going to get into that whole thing. But my point is, and then now in the last 6 months, basically, the federal government has done two things that are directly contradict the net neutrality. And net neutrality is basically the ability or inability for a government to throttle information. So if you go online, if you go keithnews.com, you should get it. And the government has done two things, Bill C-11 and Bill C-18, which ultimately are an issue that directly go against some of the tenets, not all, but some of the tenets of net neutrality in America. And it's amazing the degree to which sort of the hypocrisy in where, news media should be defending this quote unquote net neutrality, and they're absent from that conversation. That to me is very frustrating.
Well,
I don't know. There you go. We can move on, I guess, before we get
banned.
banned.
I mean, on the good news, to wrap it up, Rich, we had province of Ontario is announcing that they are in the works of expanding their nuclear facilities to actually have the largest nuclear facility in the world, larger than.
Is that right?
Yeah.
That sounds wrong, but if it's right, it's right. It sounds amazing.
I'll tell you right now. It's
if it's in the media, it must be true.
This is from CBC News. So there you go. I mean, it's got to be true. Ontario wants to expand Bruce Power, Canada's first new large-scale nuclear build in 3 decades. So basically the goal here is apparently this power plant, again, could be wrong. It's CBC News. It says 30%. It's responsible today for about 30% of their power in Ontario. And so they're looking to ramp it up to become the largest nuclear facility in the world. It's going to be larger than the one they have in Japan at the moment.
Well, I think that's awesome. Everyone who knows me knows I love nuclear power. Maybe it's because of the years watching The Simpsons, but Canada, and just for context, by the way, in 1970, Canada had 0% nuclear power as a percentage of electricity production. It rose to a peak of 20% in 1994 and is now down to a 15-year low of 14 or so. Remember last week we talked about Spain and Sweden. Sorry, Steve, go ahead. Sorry.
I was just saying, yeah. So the plant's 8 reactors currently have about 6.2 gigawatts of capacity and supply 30% of the province's power. And so they're looking to ramp that up.
Cool.
So maybe next week we'll have a bit more details on where, is this being driven from a provincial level, or is it coming from Ottawa? Because I'm a bit confused, truthfully, if it is coming from Ottawa, because I didn't think that was nuclear was on their safe list. So, but this is a great development from a power and efficient power perspective. So how about maybe next week we'll have a bit more information on it, and then we can.
So
just
it's currently producing 6.2 gigawatts of capacity. They want to add an additional 4.8. So that's, what is that? 11 gigawatts of capacity. That'd be larger than Japan's. I'm not even going to try to pronounce it. Kashiwazaki Karira plant, which produces 8 gigawatts of capacity. So it would be substantially larger than Japan's there.
Cool.
And what did it state the time frame for it to be built? How many years?
Well, it says, I mean, again, with Canada, I mean, with all the permitting process, probably take it a couple decades, but it sounds like they're in the process of actively studying it. So again, studying, permitting, it's going to take time. But I think more importantly, it's around the positive discussion that this is being pushed forward. Rich has been quite vocal on the show about some of the policymakers out there that are skeptical, talking about carbon-free and, world without having nuclear just doesn't make a whole lot of sense.
Well, Steve, as they say, you can't take the second step if you don't take the first step.
So the first step is study. Second step is get your permits. And then eventually build it. Then maybe get it built.
Then you borrow the money. Yeah.
So I think that's a good place to wrap it up. We've got our Twinkie bet for next week. So your non-farm payrolls coming out tomorrow. Look for that number. The number, Keith, you said it was 225,000. So that's the estimate. We'll see who's right, who's wrong. Again, want to remind everyone for the Vancouver event, July 27th, tickets are going to be in the link in the description in the show notes below. So go check that out. Like I said, we're about 60% sold, so love to move the last bit of those tickets there. We appreciate everybody's support as always, and we'll see you next week.